This is Debt Free in 30, where every week we take 30 minutes and talk to industry experts about debt, money, and personal finance. Here's your host, Doug Hoyes.
It's the summer of 2016, and as is our custom during the summer, we run Best of shows where we replay the most downloaded episodes of Debt Free in 30. Today is not a best of show. I've got two never-before-heard interviews for you, but it is a show about one of the most frequently discussed topics on this show, and that's payday loans. This is show number 99, and back on show number 1, which is one of our most downloaded shows, Ted Michaelis rants about payday loans. On show number 83, I had Dijkema and Rhys McKendry from Cardis talking about payday loans, and on show number 85, my guest was Jonathon Bishop, and they both had a lot to say about this topic. I asked all three of them to give me their solutions to the payday loan problem, and they had so much to say that I wasn't able to air everything in those original shows. So today, we've got their practical thoughts. To start, let's hear from Dijkema and Rhys McKendry from Cardis, who authored a study called Banking on the Margins, Finding Ways to Build an Enabling Small Dollar Credit Market. Back on show number 83, we talked about the problems with payday loans and how they charge too much money and whether or not the government should get involved. In my conversation with them after we finished recording the main show, we started talking about solutions, and I started by saying to Brian the solution seemed obvious to me. Here's what I said, and here's Brian's response. The solution seems pretty simple to me, Brian. Go out, raise $100 million. I'll kick in the first 50 million because, hey, I got, all that kind of money sitting around. We just go out and start this organization to do this. We don't need the banks to help because we're starting our own financial institution, whether it's a bank or a money market, a payday loan lender, a small loan lender, whatever. We'd be able to use all the latest technology. It'd all be online and, keep the cost down. We'd be able to tap into the network of churches and YMCAs and whatnot and have facilities in their basements and things like that. I don't need the bank. I don't need the government. I don't need anyone else if we were able to do this, and we would run it on a break-even basis. So at the end of the year, there's no profit, there's no loss. Is that the answer to your problems? Do you just need $100 million and we can make this all happen?
My response is I think there's a lot of that going on already, and folks are actually starting to explore what to do with that. So there are, as we note in our paper, there are a number of alternatives that are arising, and I know that some people have different perspectives on them, but for instance, Mogo is an online lender, there's Borrowell, there's an increasing number of peer-to-peer lenders that take exactly that approach that you say. Look, we've got some capital here. We understand that we can provide a service in a market that doesn't have a lot of diversity. And so there are lots of people who are doing that, some on the for-profit side of things. I think if there's $100 million, I do think that's a real challenge. And I think that's one of the things we recommend. There is a need for a community to get together who recognizes this as a challenge, an economic challenge, to pool their funds together to help fund and help provide some alternatives. I think, as I said, some of that's going on in the tech world, the financial tech world, but in the credit union world, they're not banks, but there are those who are working on this issue. The challenge is, of course, that if you're going to offer a product or you're going to offer these types of loans, you have to have the financial expertise and the whole infrastructure to support your delivery of that. And when you start looking around for who's going to do that or who's best suited to do that, you end up looking at financial institutions or some of these other online providers. And so I think that's absolutely the right step, that there does need to be a pooling of capital, and we're talking about that, civil society, churches, and a number of others doing that. But you do need to have somebody with a financial expertise who's able to manage loans, who's able to do some of that risk analysis that is absolutely important, that can feed into credit reporting so that people can be building it up. So there's a whole host of infrastructure that goes into the money marts. What needs to happen is that the infrastructure that already exists in the financial world needs to be redirected or focused on this issue. And if certainly, generous philanthropists like yourself have $100 million that they want to contribute, I think that's a key part in making that a success.
And so what I'd really need to do then, I guess really I need $1 billion then, is I would need to go out and buy somebody who already exists, a a payday lender, a credit union, a small bank, if there is such a thing, and then shift the focus from purely being a profit-making enterprise to being an enterprise that actually helps the customer. So we would offer loans. As you suggested earlier, Rhys, that instead of having to pay us back in 10 days, you can extend it for up to 4 months or 6 months or whatever. And we would report those loans to the credit bureau so that it is helping your credit rating, which will make you therefore more able to borrow at a regular institution at lower rates. We would obviously have a financial education component to all that. So there would be, literacy resources and things like that, explaining the cost of credit. Is that the kind of thing that would have to be envisioned in this mythical new company that we're going to raise $1 billion to get started?
Yeah, certainly all those elements are part of it. I think the real challenge is that as I've said before, the economics in this market are challenging with small dollar loans, with a consumer base that is generally higher risk. Default rates are higher, loan losses are going to be higher. You need to find a way to provide a service that is sustainable. If you look at Vancity, which is the largest credit union in Canada, they've found a way to provide a small dollar credit product that is financially sustainable for the company. Now, the way that they've done that is they've created a process that is efficient and fast, that does restrict in some capacity who they lend to, but it's providing a service that is quick and available to people that couldn't get credit from other sources. So there's a lot of challenges that are involved in providing this type of service, but
well, and what you're saying, and I'll let you chime in on this as well, Brian, even if I did have $1 billion, making these loans would lose me money every year. That's the potential risk. If I'm not charging 542% interest, then inevitably I'm going to have some loan losses, and that is going to cause a problem. So is it almost impossible to do what I just sketched out there?
No, it's not. I would say that it's not inevitable that you have major losses. Vancity is an example of an organization that has done it, and they're not making a huge profit, but it's certainly sustainable. And I think that's what they're looking at. The one challenge, I think, finance is complex, and you know how it works with folks who are in debt and what it does. I think one of the real challenges is recognizing that we're not as rational as we like to think we are, and I think that that's an important part to remember on this type of issue. Many of us can review, if we're all sort of sitting at a desk and we don't have any other worries, any other stress, we don't have any bills due right now, we can look at the 6 options out there and say, this one's going to be best for us. But that's not often the way people make financial decisions. Even smart, well-educated people, right? Even financially literate people. And payday loan firms have done a good job of getting that type of response. You get in, you get out really quickly, you're approved really quickly. And if you're going to look at providing an alternative, you have to find a way to address those issues, to make sure that you're putting people on the right path, that they're taking these challenges and actually directing them the right path rather than onto the path of dependency. Well,
and you're right. Payday loan places are very friendly. They're very easy to deal with. They're great. You go in, they make you feel good. They're happy. You qualify. Whereas when I go to a bank, oh my goodness, I get the 3rd degree, and they gotta, photocopy this and photocopy that, and it's 3 days to check my credit and this and that. So it's a problem as well. But so to summarize it though, yes, it would be possible to explore these other options, and I guess that's really what you're advocating in the study, that there is no one right answer. We have to look at the other options. So, Rhys, do you have any final comments on that, or is that pretty much summarizing it?
Yeah, I think you hit the nail on the head. Is that what we're really advocating for? Is that we need to put more efforts, more resources into research and development, and into experimenting, into piloting alternatives. There's a credit union out west in Calgary right now that, through the help of philanthropic support, that they're piloting an alternative, and they are losing money on that specific pilot. It's not a huge amount of money, but they're losing money, but they're learning a lot about how to provide alternatives, how to structure that product. So that's the type of work that we need, is to put resources and money into figuring out ways that we can provide better alternatives to consumers.
Excellent. Well, that's a great way to end it. Thanks very much, guys, for sticking around for a little bit more discussion. Brian Dijkema, Rhys McKendry, Banking on the Margins, Finding Ways to Build an Enabling Small Dollar Credit Market, a study by Cardus, C-A-R-D-U-S. Thanks for being here, guys. That was my discussion with the guys from Cardus. Here's my discussion with Jonathon Bishop. Today we're talking about solutions to the payday loan problem. How can we lessen people's dependence on payday loans? Should it be the government involved, or how should it be done? So I'm joined again by Jonathon Bishop, who is the Research and Parliamentary Affairs Analyst with PIAC, the Public Interest Advocacy Center, and Jonathon is talking to us from Ottawa today. So Jonathon, when you were on our show a little while ago, you gave some practical potential solutions to how to deal with payday loans. So, if I may rhyme them off here, what you told me the first time around, limiting the number of payday loans that someone can get in a certain period of time, lengthening the time that they have to repay them. So instead of having to pay it back in 14 days, maybe you'd pay it back in a month or 2 months, reducing the interest rates, considering the borrower's ability to repay before giving a loan. What other solutions are potentially out there that if I gave you a magic wand and said, here you go, you have the power to either change what businesses are doing or change what municipal, provincial, or federal governments are doing or change anything else, what are some other things that would be on your list to solve the payday loan problem?
Thanks, Doug. The first thing I would do, if it were me, you gave me the magic wand.
I did. Magic wand.
I would tell the federal government, essentially, to repeal the exemption that's sitting there right now in the criminal code for the usury law. And that would eliminate the need for any of these other things, because if the usury law goes back to the way it was prior to 2007, then payday lenders would have to operate in some kind of a different manner drastically, because the product they'd be offering would now be illegal.
So just can you explain that to them? And I know we touched on it in the first show we did, but when you say the federal usury law, the rate set in the criminal code is 60%. So I cannot give someone a loan and charge them a 70% interest rate. That's not allowed. That's against the criminal code. But the reason payday loan companies are able to offer a loan where, you're paying a 20% interest rate, but you're paying it every 2 weeks, so it adds up to 500 or 600%, is because there is a specific exemption in the criminal code, the federal criminal code, that allows them to do that. Am I correct on that?
That's correct. The exemption was passed in 2007. It basically describes what a payday loan is says, make a description and stick to it. And then if the provinces create the proper regulations, then payday loans as a product are allowed to be offered. And that's what's happened in a number of provinces throughout Canada. However, not all the provinces in Canada. So when you gave me the magic wand and I said, repeal the exemption, that would be great. Or you could do what the province of Quebec has done, and instead of making regulations that allow the operation of payday loans as it is in the rest of the country, they reduced the allowable maximum interest rate from 60% to 35%, and basically told the payday loan providers, deal with that particular scenario, and we'll see what products you offer then. Which has basically greatly curtailed the operation of these industry players in that province. Now,
I guess the devil's advocate response to that would be, well, okay, if you tell the payday loan companies that instead of charging $21 on 100, they can only charge $5 on 100, then presumably they all go out of business tomorrow because they don't have time to adjust to that new reality. And does that make things worse? Because now we're all dealing with loan sharks and they break your legs if you don't pay, and that's probably worse than what we've got now. Drawing on your experience in other industries, is there a way that this could be, these types of regulations could be implemented over time?
Yes, there is. One of the first research reports I did for the Public Interest Advocacy Center was on wireless data roaming. So the notion that you would go away on vacation, take your cell phone with you, your smartphone, come home and sometimes receive a large bill for using data in another jurisdiction, this bill shock notion. This was happening pretty much across the globe, say 10 years ago, and still happens to an extent today. But what the European Union did in response to this was advise wireless operators that, look, you can charge X amount for data today, but in 2 years, that number is going to drop by 20%. 2 years after that, that number is going to drop by another 20%. And laid it out in a long enough time period, so like a 6 to 8 year time period going forward, to give those operators in that industry time to adjust to a new rate. And in PX submission to the government of Alberta's call for consultation in regard to payday loan legislation, which also happened in the fall of last year, we actually suggest this as a possible consideration. We lay out basically a little chart and says, look, over the next 10 to 12 years, we suggest that you let the payday loan operators know that you're going to drop the maximum cost of borrowing by $2 per $100 borrowed in year one, 3 years from now, 5 years from now. So just to kind of say, this is a potential option.
So in theory, then, the limit in 2016 is $21 on 100, and in 2017 it could be $20, 2018 it could be $18, 16, 15, and as you go, so that eventually, like you say, 5-10 years from now, the limit is $10 on 100, or whatever the number is, and as a result, the short-term loan industry has time to adapt to it, and it becomes less of a jarring shock. Is that essentially the concept?
That's essentially the concept in play. Now, I'm sure, given this does not happen in a vacuum, so I'm sure the industry folks would have plenty of time to go back to a provincial government and say, look, this rate is now really hurting us. And that will be evidenced by adjustments in the market. And what I mean by adjustment in the market is payday loan operators will probably have to leave a market once that maximum cost of borrowing rate hit a certain level.
Gotcha, which may or may not be a good thing, I guess, depending on what they are replaced with. So we're talking about potential solutions. What other things has your organization advocated in the past, or what other things are you thinking about?
Well, one of the items that's generally overlooked and hasn't received a lot of play is the notion that when you're a borrower of a payday loan product, there's no positive in this in terms of your credit rating. Now, and usually you can't get access to a financial product with a better, say, interest rate applied to you because you don't have a credit history, or credit history maybe not be the best. What PIAC has advocated in the past is, look, if you're going to use a payday loan product, perhaps there should be some positive in terms of, if you say you've used 2 or 3, this goes into your credit history. So it kind of shows that, yeah, I've made short-term loans at a very high interest rate, but I've been paying them back. Some kind of positive contribution to your credit rating might be at least some small benefit to having to go through this process.
So the payday loan company would report to the credit bureau that the loan was paid, and potentially that shows something positive on your credit report, which may then allow you to borrow. It increases your credit score, so perhaps you can then go to a conventional lender.
Right.
Okay.
I mean, yes, I know that I can see the devil's advocate perspective that the industry is like, well, why would we help our customers go to a competitor? On the other hand, you are operating under an exemption to existing criminal code law, so maybe you should just do what the good folks at the regulators tell you to do.
Yeah, it's kind of like, okay, you're a builder, you want to build a huge condo in downtown Toronto, fine, we'll let you do it, but you got to kick in some money to pay for the roads and the schools and everything else that the residents of your condo is going to use. You get the good with the bad. So we had talked, so I think that all makes sense. We had talked earlier about in our previous show about the physical space that payday loan companies are kind of everywhere now, and we've been talking about federal and provincial regulations. Is there anything to do with real estate or physical space or anything like that at the municipal level that would have any bearing on payday loan companies?
Absolutely. A number of municipal governments have been struggling with this issue and at least bringing it up for policy debate. I can think of in Ontario, Hamilton's done this. Ottawa, there's been rumblings of this. In other jurisdictions, I think in Calgary and other cities. And one of the options that keeps coming up is to basically attempt to physically separate payday loan operations from one another through land use laws. So coming up with a bylaw that says, look, if there's already a payday loan institution established in a neighborhood, the next one closest to it can't be less than, say, 400 meters away, to kind of physically separate the institutions from one another, because they have a tendency to kind of conglomerate in certain neighborhoods sometimes. That's what the studies have shown to us. Another option that's been bandied about in these at the municipal level is the licensing fees that are associated with, say, a payday loan institution. So if you're going to operate a payday loan shop, then you're going to have to pay a license fee to the city. That's been bandied about as well, and then increasing those fees.
Gotcha. And by separating them, then it makes it slightly more difficult for me to go to one payday loan to borrow so I can pay off last week's loan. I've got to, you're putting up some barriers, and hopefully that slows people down. So, okay, so those are certainly some solutions we haven't addressed before. Is there anything else on your list of potential solutions to the payday loan problem?
No, I think I've gone through everything I've had.
Yeah, no, that's quite a few. So I certainly appreciate that. So, well, great. Thanks very much, Jonathon. I appreciate your list of possible payday loan solutions. Thanks for joining me.
My pleasure. Thank you for having me, Doug.
That was my discussion with Jonathon Bishop. We'll be back with more right after this. You're listening to Debt Free in 30.
You're listening to Debt Free in 30. Here's your host, Doug Hoyes.
Welcome back. It's time for the 30-second recap of what we discussed today. On today's show, my three guests gave their solutions to the problems caused by the payday loan industry. We covered legislative changes and other innovative solutions to the payday loan problem. That's the 30-second recap of what we discussed today. We've done a lot of shows on this topic this year, and with all of the research I've done on this topic, payday loans, my advice on payday loans is very simple. Avoid them. There is almost always a better solution. If your rent is due on the 1st, but you don't get paid until the 3rd, ask your landlord for a 3-day extension. It's unlikely you'll get evicted for being 3 days late. Then, make a plan to set aside your rent money early so it doesn't happen again. If your problem is that you have too much other debt, getting a payday loan to pay the interest on your other debt is a horrible solution. You need to deal with your other debt. That may mean doing a consumer proposal or a bankruptcy. If that's what it will take to deal with your debt, then that's what you should do. A permanent solution is better than struggling along with high-interest payday loans, because once you get on that payday loan hamster wheel, it's very difficult to jump off. That's our show for today. To find out more about dealing with payday loans, please visit hoyes.com, that's HOYES.com, for full show notes and resources to eliminate payday loan debt. Next week, it's show number 100, and I've got a special show where I'll cover our 30 best tips for living debt-free. So please tune in next week. Thanks for listening. Until next week, I'm Doug Hoyes. That was Debt Free in 30.